Karen, where do you guys at Bridgewater think that Treasury yields are going?
Well, the Fed is at a really tough, challenging moment, facing an extreme dilemma, because on one hand, we're looking at a very strong recovery that's likely to evolve here, especially as the virus fades as the main kind of cause-effect driver of the market. And there's, of course, incredibly strong fiscal stimulus that's coming our way. Inflation expectations are rising. And so the Treasury yields coming up, kind of expecting that you're going to see some tightening into that, makes some sense, especially when you have the sort of bubbly activity in parts of the stock markets that we've seen. On the other hand, the Fed does not want to tighten much too early. It doesn't really make sense to be tightening conditions before inflation has sort of really reared its head. And I would argue that social conditions, how much they've deteriorated, especially during the pandemic, with the degree of how much inequality has gotten worse, the Fed would really rather wait for the recovery to be more robust and more inclusive. And we know that they've looked at the fact that as the recovery goes on, it works its way more through the workforce, and more people kind of get back in the workforce. So I think the Fed is going to be in a tough spot, a difficult dilemma in that situation. And as an investor, looking at things like real assets in that situation, where inflation sort of has to go up first before you get a real tightening, is a good place to look.
Shepard Smith here. Thanks for watching CNBC on YouTube.